Okay, so good afternoon to everybody. Here it's 9 o'clock, just the beginning of the breakfast, but okay, the beginning of the session also with my Vietnamese students. Okay, so as you are just 25 among 44, I suppose, maybe we just use 5 minutes at maximum, 5 minutes before beginning. So uh, we begin in 4 minutes now and 30 seconds. Okay? So we wait for people who are a little late. Maybe I use this time to ask you if you hear me. Can you tell me if you hear me?
We can hear you well. Good,
Oh,
good
fine.
morning, Professor.
Yes, good morning, Tui. Thank you. Okay, so 4 minutes, we begin. Okay, you are now 31 students, so it's time to begin. And so again, have a nice afternoon. Today, I will begin by some questions about the last sessions on money creation, monetary policy, monetary aggregates. As you told me, you already had a course about that, but I will just check with some questions if everything is very well mastered. Then I know that you already had a course on the bond market, but I will make around 1 hour about this market to be sure that everything is mastered. And now after, we will go to derivatives and to hedging through derivatives, forward, futures, swap, options. And after, at 5 o'clock for you, PM, it will be the end of the session. Okay, fine. We begin by, and you tell me, please, if there is some problem, if you don't hear me, if you want some more explanation, if what I am telling is too easy and that you want that I make something more difficult. So you tell me at any moment. And again, please, if you can speak, it's better for me because here we are on Saturday. I am in Paris in my office, and it's better if I am speaking with my computer. So if it's better if you speak with me or if you send me a message. Okay, fine. Okay. So some questions about the last sessions. 6 questions, and maybe you answer by a message, and after I give you the official answer. Basic questions, but very important. Who is creating monetary base or base money? Banks, central banks? Tell me. What is very important to understand is to make the distinction between monetary base and money stock. Central bank, yes, that's perfect. Don't forget that if you, how can the bank, it's a second question. Okay, you can send me a message. How can the central bank create monetary base? Because monetary base is created by the central bank, and money stock is created by banks, essentially, when they lend. If you lend from your bank, Vietcom Bank, okay, your deposit account will increase by the amount of what you are borrowing. So immediately when a bank lends, give a credit, it increases the deposit account and the money stock increases. That's very important. But if someone is borrowing from its bank, for instance, 100, the money stock moves up by 100, but maybe and probably you will ask for banknotes around in France, in the Eurozone, banknotes are around 10% of the money stock. So you will ask your bank, Vietcom Bank, give me 10 in banknotes. And the bank, Vietcom Bank, cannot print banknotes. Only the central bank can print banknotes. So Vietcom Bank has to buy banknotes from the central bank, and it has to borrow. Vietcom Bank borrows from the central bank 10, and with 10 monetary base created by the central bank, okay, as a counterpart of borrowing from the bank, it will Vietcom Bank can buy the banknotes. Okay, so how does the central bank create monetary base? Can you answer? You told me and you know that the central bank creates monetary base, and my question here is how can the central bank create monetary base? Some of you are writing. I wait for the answers before giving the answers. Okay, central bank will sell bond for commercial bank, then they issue base money to pay for commercial bank. That's okay. I will try to use pen. I am not sure it's okay, but I will try to do that. Okay, so here you have the Vietcom Bank, commercial bank. Here you have the central bank, Ooh. Okay. That's the balance sheet. Okay, we don't see very well, but that's the balance sheet. There are two ways for the central bank to create monetary base. First, as your colleague says, is assume that the Vietcom Bank has on the asset side of its balance sheet here what credits, and bonds, for instance, and also equities. Okay, if you look at the asset side of balance sheet of banks, commercial banks, we have credit because it's the economic role of banks to make credit, but also bonds and equities or other assets. Okay, so quantitative easing, as we say, which has been implemented in United States in November 2008 during the subprime crisis, also in the Eurozone, in Japan since 1990, Japan implemented a quantitative easing. What does that mean? That means that the central bank, as your colleagues say, buys. Imagine you have bonds for an amount of 100. That's the price, imagine, or the nominal value. We will discuss that after. Okay, the central banks buy. If the central bank buys, the bonds come from the balance sheet of the commercial bank to the balance sheet of the central bank. So here you have bonds, okay, for 100. But if the central bank buys bonds from banks, it creates monetary base. That's it moves up the deposit account of Vietcom Bank. So Vietcom Bank here, its deposit account at the central bank is now 100. What is that? That monetary base. So one way of creating monetary base is to buy bonds or credits. For instance, the Federal Reserve Bank of New York in November 2008, when it implemented the quantitative easing policy just during the subprime crisis, it bought 50% credits and 50% treasury bonds. Okay, so now at the asset side of the central bank, the Fed in New York, you have subprime credits and you have bonds. Okay, and each time the central bank buys bonds or credits from commercial banks, it creates a monetary base. That's very important. And do you remember, I hope so, that if banks have monetary base, they can lend more. Why? Because if one of you is asking for a credit, okay, for instance, you want to borrow 300 from the Vietcom Bank, you go to the Vietcom Bank and you say, okay, I would like to borrow from you 300. The Vietcom Bank here say, okay, you are a good student, you had a marvelous course on derivatives, and so I lend you because I am sure you will reimburse me. So credit, okay, your name is T Fong An Lee, and I lend you 300. I put on your deposit account 300. Deposit, okay, to you, it's your account, TPN Illy, you have 300. Now, you will ask from, you will ask, for instance, 30 in terms of banknotes. Okay, you say I would like 30. Okay, so your account will be only 250 here, 270. But the Vietcom Bank cannot print money. Just the central bank can print money. So the Vietcom Bank will buy banknotes from the central bank. So if you have here 30, for instance, on your account, you can lend 300 because you need to get only 30 because it's 10% of the money stock. Okay, so if you have 30 on your deposit account, monetary base, you can lend 300. If monetary base is now 200, the bank can lend 2,000 10 times, because to lend 300, you need only 30 in terms of banknotes. So if the central bank implements a quantitative easing policy, accommodative monetary policy, giving a lot of monetary base to the bank can lend a lot. It's why they implemented quantitative easing policy. So, to the
Professor,
question, yes.
I'm sorry, but I cannot see what you're trying to show me. Like, I can just see the sixth question.
You cannot see what?
Are you trying to show like the balance of credit and debit?
Yes.
I don't think that we
Credit
can
is
see
here,
that.
debit is here. Yeah.
I don't
Okay,
think that
maybe
we can see your screen.
You cannot see what I am writing?
No.
You don't see. Okay, because I wrote on the slide with a pen, but you don't see what I am writing.
No, I don't see anything at all.
And do you see my slide?
Yes, I can see your slide with 6 questions here.
Sorry. So normally, because okay, thank you to tell me that, because okay, I will make a test here. Do you see the slide? Some questions about the last sessions. Do you see this slide?
Yes, I can see the slide.
Okay. If I write your TUI, for instance, here I write, okay, with my pen. Do you see TUI on the slide or not?
No, I don't see your pen.
Okay. Okay, so I will do that without a pen. I don't know what it does not work, because I was told it worked very well. Okay, so thank you. Okay, so I will speak instead of writing, and thanks a lot to tell me that. How can the central bank create monetary base? First, when the central bank buys bonds or credits from commercial banks, it creates a monetary base, because it moves up the deposit account of bank. Okay, if a Vietcom bank sells part of its bond to the Central Bank of Vietnam, the Central Bank of Vietnam will move up the deposit account of Vietcom Bank at the Central Bank. And as the deposit account of banks, commercial banks, at the Central Bank is named monetary base, the monetary base increases. And what I was telling just before is that if the bank have more monetary base, they can lend more. Because roughly, if someone borrows 100 from its bank, the bank has only a need of 10% of that. That is, if you borrow 100, you need just 10 of monetary base. So if you have 10 of monetary base, you can lend 100. If the bank has $1 billion monetary base, you can lend $10 billion. That's the idea of quantitative easing. It did not work, as I told you before, well, but okay, that's the principle. And how can the central bank also create monetary base? The good answer is here. There is a second way. Either you can sell when you're a bank, you can sell your bonds or your credits, but you can also borrow from the central bank. If the Vietcom Bank borrows 100 to if the commercial bank borrows 100 from the central bank, okay, the central bank creates monetary base. Okay, it moves up the deposit account of Vietcom Bank, of the commercial bank. Okay, so two ways for creating monetary base. Either the central bank buys credits, bonds from banks, and it creates their deposit accounts, or the commercial bank borrows directly from the central bank through different networks. But you told me that you had already a course on these questions with a colleague of Dauphine, University of Dauphine, so I don't go in details on this on these topics, except if you ask me. Okay, third question, very easy. You answer very quickly. But if you know that monetary base, money stocks, the distinction, really you are very good. Okay, because it's very important. Do banks or central banks create monetary mass, money stock? Who is creating money stock? It's an easy question. Yeah, sure. That's bank. Bank create, yes, commercial bank. You are right. When they lend, when they lend. Again, what we call in monetary economics the money stock counterpart. It's credit. Okay, you banks create money when they lend. You have two other uh, ways for creating money. The treasury can also create money when the treasury makes public expenses. For instance, it gives money to companies or to household. It creates money also. So treasury also creates money. And then when you have exports, you sell abroad some merchandise. You sell rice, you sell wheat to foreign countries. You receive dollars, you receive euro, you sell them, and when you sell them against your currency, you create also money. So I remember, but I suppose you know that very well, that money money is created first by banks when they lend. It's around 90% in the eurozone of money created by banks when they lend, and 10% is exports when the balance of payment is positive. You receive money and you create money, and also the treasury can create money. um, Fourth question: do you think that the quantitative easing policy has led to the expected increase of what? Let me just, I will, sorry, I have some difficulties with that. Okay. Do you think the quantitative easing policy has led to an expected increase of monetary mass, of money stock? Do you think that the money created by central banks in Japan, in United States, in the eurozone has led to an increase of the money stock? The answer is no, because nobody wanted to borrow from banks. And what did the traders do with all the monetary base? They bought financial assets. And it's the reason why the equity index moved up a lot in the United States. The bonds moved a lot up in the United States, in the Eurozone, and the interest rates moved down a lot. You know probably now that we have on German bonds and French bonds negative interest rates on bonds. Okay, so it has not worked. Okay, so I don't go in details except if you ask me. Why do some financial experts think that the consequence of quantitative easing has been a financial bubble? It's exactly what I told you 1 minute ago. It's because with all the monetary base created by central banks, when they bought a lot of credits, bonds from banks, traders, 50, not 50, 25 years old traders, okay, received a lot of monetary base. And as nobody wanted to borrow money in the bank, they used this monetary base for buying financial assets. And the price of financial assets moved a lot. If you look at the equity index on the US market, on the Eurozone market. If you use the behavior of the bonds in the United States or in the Eurozone, they moved up a lot. Interest rates move down a lot because there was a lot of monetary base in the economy. Last question before going to the lessons, the today lesson. What do we call tapering? We spoke a lot of tapering for last Thursday. Christine Lagarde, the president of the European Central Bank, said in a famous sentence, because everybody here in every newspaper there is this sentence: the lady is not tapering. Okay, what does that mean? The lady is not tapering. What is tapering? Can you explain just by message or taking? What is tapering? Some of you are writing. I wait for the answers. Tapering is stop implementing quantitative easing. But that's perfect. Very good answer. Okay, it's exactly that. Tapering is stop partially, not all the quantitative easing program, but it stop implementing quantitative easing. Is buying less, a lower amount of bonds each month. Okay, so you reduce the amount of bonds you buy from banks. Be careful. Okay, tapering. It's not, and one of you is giving another answer. Tapering is making the quantitative easing process slower. Exactly what I said. That's perfect. Like buying less of, oh, very good. Less securities, bonds from commercial bank. Okay, I cannot explain better than that. That's perfect. Okay, so but be careful. What is the risk? Because Christine Lagarde was waited. Okay, because there was a news conference last Thursday, and every trader in the world was, we wait for Christine Lagarde's speech. Uh, uh, are we going to tapering in the Eurozone or not? And you have the same debate in United States. Do we implement tapering? Do we buy a lower amount of bonds from commercial banks? Okay, what is the risk? If Christine Lagarde says, okay, we implement tapering, and next month we buy a 20% lower amount of bonds, and the month after 20% lower. Okay, so you say that you will buy a lower amount of bonds from commercial banks. What is the risk? What is monetary policy? An exercise of communication. I am very serious. Monetary policy is an exercise of communication. If you are not good in communication, it can be terrible on the markets. Just explain me why it's so important to say, not to say that you will not implement immediately tapering. What happens if Christine Lagarde had said the lady is tapering? What happens? One of you is writing. I wait. I wait the answers. One of you is writing. I wait. It means the central bank does not try to use an effective tool to control the money base. Yes, but it's okay. But there is another consequence. Imagine that the president of the Fed in United States or Christine Lagarde, president of European Central Bank, said, we will begin tapering. What happens on the markets? What do 25 years old traders in trading rooms in the banks in the world, what do they do when they hear, oh, we will begin tapering? What happens? When you say it means that the central bank does not try to use an effective tool, yes, you are right, you are right. But there is another consequence on the markets. Some of you are writing. I wait for the answers. Okay. I did not receive the answer just now, but on my screen I see some users of the system are writing. So if you are writing, I suppose I will receive your message. Okay, because quantitative easing may cause inflation. Yeah, that's an idea, but okay, maybe another is writing something. Okay, in the absence of tapering, the money supply will be supposedly large, meaning that it will be cheaper to borrow. The interest rate will be supposed low. That's true also. Indication of futures increase of interest rates. Okay, let me just okay, what you said is okay, but the last okay, so another answer. Starting tapering means central bank will slow the process to buy the securities. Yes. The new base money is creating less. Yes. It means that the economic may be going well already. Yes. But my question was about the consequence of indication of uh, uh, beginning tapering. And I would like to look at the answer given by TWE, indication of future increase in interest rates. Yes, suppose after this lesson, not this lesson, my course, you become a trader in a bank in Vietnam or everywhere. You are a trader. You are a 25 years old trader. You have your Bloomberg screen, your Reuters screen on your computer, and you are listening to the news conference, and the president of the European Central Bank says, we will begin tapering. Oh, you say, what will happen? If the central bank begins tapering, as each of you told me, wrote perfectly, the amount of bonds bought by the central bank will be reduced. So the demand for bonds will decrease because the central bank will not be here to buy the same amount. First, if the demand for bonds moves down because the central bank is no more here, the price, it was the expected answer, the price of bonds will move down. because you have not the demand for bonds coming from the central bank. On the bond market, the price will go down. And if the price goes down, as you say, probably the interest rate will move up. So you are um, you are 25 years old. You had a course on derivatives, and you are listening what is saying Christ is the president of the Euro Central Bank. And the president is saying, I will begin tapering. You see immediately, all the traders in the bank will think the bonds will move down. And as you are very clever, better than all your colleagues trading bonds, immediately you sell bonds. But every trader has the same logic. He says, oh, I am better than my colleague in Vietnam. I know that beginning tapering means bond move down. I am better than my Vietnamese colleague or my US colleague. I sell immediately my bonds. But everybody does the same thing, mimetic approach. And everybody sell bonds. And you have what we call a crash, a bond crash. And if you have a bond crash, the interest rates move a lot. Okay, move up. So it is very bad for the economy. So it's an exercise of communication. When you lead a central bank, you are the president of the central bank, be careful with what you are saying. Because if you say that you will sell bonds, everybody will sell bonds. Because we know that when the central bank sells bonds or buys a lower amount of bonds, something, the price will go down. And as you are paid for getting money, for earning money, immediately you sell bonds. And every trader in the world will do the same thing. So you have to be very careful with that. And when Christine Lagarde, our president of the European Central Bank, said, the lady is not tapering. Look at the sixth question. The lady is not tapering. It was introduction of its news conference. The lady is not tapering. What does that mean? Traders don't sell bonds. I will not reduce the amount of bonds I buy each day or each week on the market. The lady is not tapering. Okay? It's the same thing in the United States. You know, John Powell is also indicating that he does not know at which moment he will implement tapering. And normally you have to do that in a hidden way. That is, you begin to sell, but not publicly. Okay, slowly you sell your bonds, which are on the asset side of the balance sheet of the central bank. Okay, so panic selling, sure, panic selling. Yeah, sure, a very good answer, panic selling. Okay, fine. I think that we finish with a question. And now, some things about bond pricing. Okay. Okay, just before the break, at around for you, as I told you, 3:30 around. For bond pricing, quickly, for bond pricing, because I know that you know bond pricing. You have two main approaches to price bond: actuarial method and zero coupon method. Actuarial method, the price is a discounted value of all future cash flows with the same discount rate for each year, called the yield to maturity. You tell me if something is not clear, not known. Normally, you know that very well. Okay, so the basic method for pricing a bond is just a bond is what? Is a sequence of cash flows. Coupon for coupon bonds, because as you know, some bonds don't pay any coupon, what we call zero coupon bond. Okay, you don't receive any coupon. If I buy a zero coupon bond 10 years, in 10 years, I will receive 100. Before 10 years, I will receive 0. But today I will pay less than 100, maybe 90. If I pay 90, if I hold my zero coupon bond during 10 years, I will have an implied interest rate, an implied yield, but without any coupon. It's a moment to tell you, and I will come back on these topics with negative interest rates, to remind you that you have to make the difference between the coupon and the yield. The coupon is the flow you receive if you buy a bond, except a zero coupon bond. But imagine you buy a 10 years bond with a coupon of 2%. That is that each year you will receive 2% of 100. And at the end, in 10 years, you will receive 100 too. What is the price of that? You discount each cash flow. So it's 2 divided by 1 plus yield, plus 2 divided by 1 plus yield square, and then 102 in 10 years divided by 1 plus yield power 10. Look at, in this method, you discount each cash flow with the same yield. Okay, so you discount the cash flow obtained in 1 year, the coupon, at the same, the yield is the same as the discounted, the yield you use for discounting the cash flow you receive in 10 years. Normally, it's not correct because the interest rate is different in 1 year, 2 years, 10 years. And here, to have a simplification in this method, we discount each future cash flows at the same interest rate, which is called the yield. Okay, so to be maybe more precise, imagine the Treasury issues a new bond, 10 years, coupon 2%. Okay, okay. Imagine the bond is priced, people buy it, and the price is assume 100. People buy 100, a coupon bond with 2%, and at the end you reimburse 100. Okay, so what is the yield? If the guys buy 100 and the market with price with prices, okay, you buy 100, your yield, the return is 2%, the same as the coupon. Maybe I hope you know that if the yield is equal to the coupon, the price is 100. So now imagine that a lot of people imagine that Christine Lagarde, the president of the European Central Bank, says, I will begin tapering, because she's a little drunk. She drank a lot of alcohol, of wine, and at the news conference, she introduces by saying, I will begin tapering. She's very, very happy because she drank a lot of wine. All the traders sell bonds. And the bond whose price was 100 now is traded at 90. So people now who buy the bond 90, paying a coupon of 2%, so the coupon has not changed, have a higher return because they pay only 90. And there is a computer who calculates the new yield. That is 90 is equal to 2, it's the first cash flow, divided by 1 plus yield, plus 2, the second cash flow, divided by 1 plus yield square, and it calculates the new yield. And as you know, if you buy 90, the yield will be higher than 2% now. Maybe 3%, 4% of yield. Okay? If the price moves down, the yield moves up. And what is the more important, if you observe the bond market, is the yield, not the coupon. The coupon has no interest, but the yield moves every second because people buy and sell bond every second. Imagine now that Christine Lagarde now, someone is coming and saying, no, Christine Lagarde was wrong. We will not begin tapering. Sorry for that. She was a little drunk. Christine Lagarde, we will not begin tapering. Immediately, what do people do? They think that the price will move up now. They buy. And imagine they buy a lot. And the new price is 105. If you buy a bond at a price of 105, paying a coupon of 2%, and when the computer calculates the new yield, the yield will be lower than 2% now, because you bought at a higher price than 100. So the yield is depending on the price. First, all bonds are traded in price. We trade, we say I buy 90, 95, 102, 103, and then a computer computes the yield. You don't say I would like to buy a bond with a yield of 2%. It does not exist. You buy the bond at a price, you pay 100, 102, and then the computer tells you, okay, buy a bond at 110 with a coupon of 2%, has a yield of, I don't know what, maybe 1% only, okay, because you paid a lot, high price, okay? So you have to be very clear with that, okay? We trade bonds, we pay a price, the coupons are stable, the same, and we compute the new yield. And when we say, very important, the interest rates in the Eurozone on the bond market till in Germany 15 years, in France 10 years are negative. Probably you know that. We say that interest rates are negative on treasury bonds in Germany and in France. It's not the coupon which is negative. You receive a coupon if you buy a bond. But some people, some investors buy these bonds at a higher price than 100. So if you buy a bond paying a coupon of 2%, and if you pay for that 110, you will get a yield which is probably negative. Okay, let me give you a better example. If you buy a zero coupon bond, imagine 1 year. If you buy a zero coupon bond 1 year maturity, you will receive in 1 year 100. And if you pay this bond at a higher price than 100, you pay, for instance, 102 for buy a bond, which is reimbursed only 100. You have a negative yield. Your coupon is zero, but your yield is negative. It's exactly what happens in Germany and in France. Yields are negative. Interest rates are negative. But when we say interest rates are negative, that yield, that means that people buy bonds, for instance, zero coupon bond, higher than 100. And maybe you ask, but why some investors buy bonds with a negative return? The investors are ridiculous to buy higher than 100, something which is reimbursed 100 in 1 year. No, because as maybe you know, or maybe you don't know, in the Eurozone, again, the deposit, the interest rates when a bank, on the deposit account of banks at the central bank, the interest rate is negative. So all the monetary base held by bank at the central bank has a negative return. It's minus 0.5%. So if you are a 25 years old trader, you have monetary base with an interest rate of minus 0.5%. Okay, what do? You buy something. You buy risk-free assets instead of your deposit account, and you accept to buy bonds with a negative yield of minus 0.49% instead of 0.5% on your deposit account. Okay? The second method now, do you have any question? Because I thought I could write, but as your colleague said, you don't see anything when I write. So I will check during the break if I can improve. Um, oh, someone is writing. I love when someone writes. I can see your pen now. Okay, let me. Okay, let me just look my pen. Tui, I write Tui. Do you see something? I wrote Tui. Sadly, no. Okay, so we will make the break pretty soon, and I will check what happens because I was given a new computer with it's not a computer, it's something I can write on and connect it to my computer, but probably there is a problem. I suppose you have to share whole screen, just not PPT screen. I'm not sure. I will try to do that, but I'm not sure. I will do that. No, I cannot do that. Okay. Okay, you don't see anything on the slide. No. Okay, so I finished without writing and with just 5 minutes, and after we make a break, and after we okay, I try to do better. Okay, so the first method is what we call actuarial method. Uh, I remind you that sorry. Okay, you discount you buy the bond with a price, and then we calculate the yield, but the yield which is calculated is the same for every year, so you don't introduce any interest rate curve, yield curve, because you discount every cash flow in this methodology at the same yield. The second method is zero coupon method. Okay, what is the zero coupon method? Okay, the zero coupon method, sorry, because I have, okay, is when you, okay, no, that's not the good. Up. Okay, in the zero coupon method, I just tell you that because I was supposed to write, is when you discount each cash flow, okay, received at the corresponding yield. It is, if you buy a bond with a coupon of 2%, 10 years maturity, the price of the bond, you say, will be 2 divided by 1 plus yield of the 1 year yield, that is the 1 year interest rate, plus 2, the cash flow you receive in 2 years, divided by 1 plus the 2 years yield square, and the 2 years yield is not the same, that's a 1 year, etc. And you discount each future cash flow at the corresponding yield, 1 year, 2 years. So you need what we call a yield curve to price like that. It's more difficult than pricing with one interest rate called yield. Okay, it's the reason why what is very good if you use the actuarial method is that if you buy a bond at I don't know 102, we say okay, your yield is 1.35%. So you know what is the return when, of your investment. But for people who know that, and I hope everybody knows that, the yield is your return if you invest each received coupon in the future at the same yield. Okay. If you don't know that, tell me after the break, and we will. I hope I can write and make something. Okay. Sorry for this small difficulties. Um, Okay, maybe. Sorry. I am Okay, so what I propose is to make a break now after this small introduction on bonds. I have some exercises on bonds just after, and after we go to derivatives. Okay, have you one questions before the break? That's okay. Okay, I suppose that's okay. So have a nice break, 15 minutes, and I come back and I hope I can write in 15 minutes. Okay, so break now. Oui. Chérie? Nadia? Lulu? Tu peux m'apporter du thé? D'accord. Ah ouais, non, mais attends, parce que là, il n'est pas sur la table de chevet? Oui, mais alors, dans combien de temps j'arrête alors? So, okay, just the same question as each time. Do you hear me? Nobody hears me? Yes, prof. Okay, fine. Okay. So I'm not sure it works, writing. I will just make a test, and if it does not work, I will do without this possibility. You tell me I write something on the slide. Do you see the slide with a screen with quotation? Yes? Okay. And I write now. Okay, no, like that. Let me. I write bond. Do you see? Whoa. Do you see bond here when I write bond? Do you see it? No. Okay. So I think it does not work. That's not a problem. Okay. Okay. So we uh, we okay. Okay. About the bond market here. If you become a trader in a Vietnamese bank in the trading room, um, buying and selling bonds, you will get on your screen, on your computer, this screen. That's the screen uh, that all the bond traders in the world use, given by Bloomberg. And my objective here, as you know, lot on bonds is just to understand each feature to be sure that you are able to become quickly a bond trader. Okay, maybe at the beginning it's not so easy to understand every feature here. Um, I would like to ask you a question. Explain the relation between coupon, yield, and price. And please, I will give you a small exercise. You take the first line. Look at the first line. BK 0009 15 33 2 years bid ask price yield change low range high average. Please just you look at the first line and you explain me each element of the screen. You tell me each element. I give you 3 minutes, and you can send me your answer by speaking or by message. What does that mean? What means BK00091533? First element on the left side. What does bid ask price mean? Why 101.518 at 101.549? What does that mean? Yield. Okay, you listen to this screen. If you are able to understand each element of the screen, you can be a good bond trader next week. So look at, okay, 3 minutes. You can send me a message and explaining each element of the screen, bond market screen. Okay, I will try to explain. Look at the left column, security. Security means bond, okay? Because security is a global term for bonds, equities. And here we are on the bond market. BK Security, first line left. BK, it's the name of Bundes. K does not mean anything, but it's a German Bund, Treasury Bund. Okay, Germany, as you know, it's the price of a bond issued by the German Treasury. Here we are on the secondary market. Okay, so what does first 00 before 09, 15, 23? Easy. 09.15.23 is in fact the maturity of the bond, the expiration date of the bond. It's a bond roughly with a maturity of 2 years, because the maturity is 15 of September 15, 09 September 23, it's the year expiration. So here we are traded on the secondary market bond with a maturity of 2 years, roughly 2 years. As you look, you have here what we call the benchmark. That's other bonds, German bonds, which are traded on the secondary market from 2 years to 30 years, because you can buy and sell 30 years maturity bond. Okay, so first line again, 00 before the expiration date. Okay, left side you have BK 00, and after 09, 15, 23. 00 is the coupon. So it's exactly what we call a zero coupon bond. It's a zero coupon bond. It's the German Treasury has issued bonds with a zero coupon, and these bonds are traded on the secondary market. Normally, if you buy this bond, you will receive in 2 years, 15 of September 23, 100. By convention, I suppose that you know that we price bonds with a nominal value of 100. So if you buy this bond, you will receive 100 and no coupon before. So you tell me, if I buy this bond at 100, my yield is 0, because I pay 100 today, I receive nothing, and at the end I receive 100. So my return is 0. If I buy this bond at a lower price than 100, I have a positive yield. If I buy this bond 98, giving me 0, 0, 0, and then 100, I can compute my yield. Okay, it's sorry, because okay, maybe I will try to write with here. Do you, because it's with my mouse now, if I write T, do you see T on the slide? Do you see T? No. What happens? Okay, sorry. Okay, so I'm obliged to speak instead of write. Again, here the price of the bond traded on the market. So when I made the picture on Bloomberg, is traded, bid price is 101.518, and ask price is 101.549. First, you have here bid and ask. As you probably know, I don't know if you know that, probably people working in finance know that, when you ask for a price on the market, you are an investor, for instance, and you want to buy a bond, this bond, you want to buy it because you are an insurer, you are a fund, a hedge fund, you are a pension fund, you would like to buy short maturity German bonds, this one. You ask in a trading room, you ask a trader and you say, okay, I would like to buy these bonds. And the trader gives you two prices. The price at which he is okay for buying the bond. because it does not know, in fact, if you want to buy the bond or if you want to sell it. So he says at 101.518, I am okay for buying the bond from you. And at 101.549, a slightly higher price, I am okay to sell you the bond. So bid ask, bid price is the price at which what we call the market maker, the guy, the trader who is asked by another one, is okay for buying, and the ask price is the price at which he is okay for selling the bond. And the ask price, as you see, is every time, that's normal, higher than the bid price. Okay? On interest rates, we don't speak about bid ask, but about bid offer. Offer. Instead of ask, you have offer. OFFER. And you know, everyone knows the LIBOR, London Interbank Offer Rate. That's the rate at which the market maker is okay for lending money. Okay, and if it's borrowing money, it's what we call the LIBID. It's smaller interest rate. Okay, so bid ask for bonds and for equities also. So I am the investor, or a hedge fund. I am a hedge fund. I want to buy this bond. I call my market maker. He gives me its price, the two price, bid and ask, and I say, okay, I 101.549, right price. I buy from you this bond. So you pay this bond, which is a zero coupon bond, which will be reimbursed at 100. You pay it higher than 100. It's exactly because you will get a negative yield, a negative interest rate. The coupon is zero, but the yield is negative because you pay at a higher price. And as you see, when the computer calculates the yield is negative. What does that mean? That means that if you buy today the bond at a price 101.549, and that if you receive 100 in 2 years, you invest your money at a negative interest rate of minus 0.75. And why? And who is okay for buying this bond? People with a deposit account which is negative. Banks, I told you, at the central bank, have a negative interest rates on the deposit, minus 0.5%. And some people who have money in banks have more negative interest rates. For instance, some insurer on the deposit account in banks have a negative yield, interest rate, which is maybe minus 0.80. If I am an insurance company, I prefer to buy a German bond, 2 years maturity, risk-free, with a yield of minus 75 or 75. I prefer that to make a deposit account, a deposit in my bank with minus 0.8%. Imagine that today the central bank decides that your deposit account in your banks, in Vietcom banks or other, becomes negative. Okay, so your money, which is in your bank, okay, has a negative interest rate, minus 5%. Very important decision taken by the president of the Vietnam Central Bank. What do? You prefer to buy bonds, risk-free bond, with a negative yield of minus 0.49%, 4.90%, sorry, instead of keeping your money on your bank with minus 5%. So why do we say that in the world some interest rates are today negative? Just because the interest rate on deposits for banks and some and some institutional investors is negative. If tomorrow the interest rate on deposits made by bank at the central bank moves up to zero, no bank, nobody will buy bonds with a negative interest rates. If my deposit account has a zero interest rate, I prefer to have zero than buying the first line bond, the zero coupon bond with expiration 23 at a price of 101.549 with a yield of minus 0.75. I prefer not to buy this bond. I don't buy this bond if my deposit account has an interest rate which is zero. So that's very strange what happens now in the world. In countries where what we call the deposit facility, that's the interest rates on the deposit of banks at the central bank. In countries where this interest rate is negative, most of bonds, treasury bonds, are negative. Not every treasury bond, because the arbitrage between deposit account in the central bank and investing in bonds, you need to buy risk-free bond because the central bank is risk-free normally. So you will buy Bund, German bond, French bond, but not Italian or Portuguese or Spanish bond. And Italian bonds, Spanish bonds have a positive yield. Bonds have positive yield because banks don't buy these bonds. They buy these bonds, they buy German bonds and French bonds. Okay? Yield change, okay? Low, that's the lower yield in the trading day. Okay. If we look now at the second line, just to be sure we understand everything, it's OBR, it's the name of the bond. Zero is again a zero coupon bond. 10, 18, 24, it's 18th of October 24. That's the expiration date of my bond, roughly 3 years. So it's written after 3 years. If you buy it, you will receive a coupon of 0. But in 3 years, you will receive 100. Investors buy these bonds at 102.475 ask price, as you know, as you see. If I am an insurance company, this bond 3 years at a price of 102.475, and I am reimbursed 100 in 3 years with no coupon, my yield is negative. So I have a negative yield again. And as you know, till 15 years, it's close to the last line, 50 years bond, the yield is negative. So who is happy? Tell me who is happy with negative interest rate. Tell me who is happy. Write something or please speak. Don't forget, I only speak to my computer. And my computer does not want that I write on the slide. So it is very, very angry. I don't know what, but it does not want. Okay, so who is happy with these negative interest rates? Can send me a message. Nobody wants to answer. Who is very happy? Central bank. First answer, central bank. Borrower. Which borrower? Which borrower? Issuers of bond. But TUI, is very good. The other answers, I will analyze them. Okay, 3 tells us issuers of bonds. Yeah, sure. More precisely, the Treasury state. Why? Because look at, for instance, the German Treasury. Today, it issues 10-year bonds, maturity 10 years. Okay, you issue 10-year bond, you are the German Treasury. Angela Merkel, its finance minister, to finance the deficit, says, I will issue 10 years bond, zero coupon bond. Immediately, you look at your screen, line 5, D, it's Deutsche Bundesrepublik, coupon 0, maturity 15 of August, 08, 15, 31, it's 10 years. And if you issue this bond, investors buy the bond 104. Look at what happens for the German Treasury, which is the issuer of the bond. It receives today 104.35. You receive this money. You don't have to pay any coupon because it's a zero coupon bond. And in 10 years, you will reimburse 100. It's marvelous. You have a negative borrowing rate. Okay? So one of you said borrower, he's absolutely great. He's right. The borrower is very happy with negative interest rate. And the central bank today has a deposit facility for banks. That is the interest rate that bank receive on the deposit account, which is negative at minus 0.5%. Who is very happy? All the German and French Treasury, because they receive more money than they have to reimburse at the end. You understand that? That's really strange in the monetary history. Never we had negative interest rates. You don't have negative interest rates in United States. You don't have. Why? Because banks in United States, when they make the deposit money on the deposit account, they have a positive interest rate. So they don't want to buy US Treasury bond with negative yield, because if they keep their money on the deposit account at the central bank, they receive a positive interest rate. Okay, so the central bank, the European Central Bank, is very, very nice with the Euro Treasury. It allows them to receive more money than they have to reimburse. That's very nice from them. Thanks a lot, central bank. We believed that the central bank was independent normally, politically. The central bank is supposed to be independent. I don't know if it's true, because here you see that you allow the French Treasury and the German Treasury to borrow more money than they have to reimburse. Okay, I would be happy if it's okay for me. I go to my bank, I say, okay, I borrow from you $10,000, and I will reimburse $5,000. Thank you, the bank. Okay, here it's thank you. Why are yields negative? It's the second question on my slide. As I told you just before, because the interest rate on the deposits of bank at the central bank are negative. Do you have some question about this very interesting screen? That's a professional screen, Bloomberg. If you want to become a trader, a bond trader, you will see every day, every minute, this picture, this screen, okay, and you will buy, sell bonds, and you have to understand. And now I hope you know the difference between coupon, yield, and the relation between coupon, yield, and price. Okay, the price is higher than 100, the coupon is 0, so the yield is negative. Okay, fine. Have you any question? No question. Great. Voilà. Okay, look at now, come back, look at the fourth bond number 4. It's DBR, it's Deutsche Bundesrepublik, it's the name of the bond, issued by the German government. Coupon 0, you see, just after a 0. Maturity date, it's 7 years, okay? It's 15 of November 28. Okay, it's roughly 7 years, I understand. What is the price given by market makers in the trading room at the moment when I made the picture? If you want to buy this bond, you will buy it at 104.466. So you will get a negative yield. The negative yield computed by the computer is minus 0.64. Okay. Maybe you put this data on a sheet of paper beside you, because after we will make some computation on this data. So maturity is 7 years, price is 104 if you buy it, 0.466, and the yield computed by the computer is minus 0.664. Okay. Okay, so I take this bond. Coupon is 0%. Yield is minus 0.64. If you want to have a roughly idea of the price of the bond, I have a small method for you. That's very okay. What you say, if you want to know the price of this bond, roughly, without any computation, just quickly, coupon bond, coupon 0, yield minus 0.60. What does that mean? A bond, that's theoretical. A bond with a coupon of minus 0.64 would have a price of 100. As you know, and I will give you the demonstration if you don't know it. If the coupon is equal to the yield, the price is 100. Or if you prefer, if you buy a bond at a price of 100 with a coupon of what you want, 2%, the yield is 2%. So when the yield is equal to the coupon, the price of the bond is 100. Or if the price of the bond is 100, if you buy it at 100, your yield will be equal to the coupon. Okay? So, and you have to demonstrate that, but it's easy to demonstrate from a mathematical point of view. So first step, you know that if a bond has a coupon equal to the yield, its price will be 100. This bond is a zero coupon bond. So its price will be higher and close to 100 plus the sum over 7 years of 0.64% discounted. Why? Again, if the coupon was negative, minus 0.64, the price would be 100. If you buy this bond, you receive a zero coupon. It's 0.64 higher than the yield. So its price will be higher than 100. How much? 100 plus 0.64 per year discounted over 7 years. So if you don't discount, the price of this bond will be close to 100 plus 7 times 0.64, which is 104.43. And if you look at the price, you have a price of 146. You know, you are able now with this methodology to know the price directly, the price of a bond, roughly, not exact price. To do that, you must use a computer, but it just, oh, this bond has a yield of minus 64, maturity 7 years, zero coupon. I know that the price is 100, roughly, plus 7 times the difference between coupon and yield. Because again, if the coupon was negative, minus 0.64, you will get a price of 100. I have after, okay, if you now exactly compute the price of the bond is 100, because it's a zero coupon bond, divided by 1 plus yield power number of years between August 20, okay, it's when it's not 20 but 21, and November 28, okay, so it's 7.20 years, 7.22 years. If I exactly compute the price is 100 divided by 1 plus yield power number of years, 7.22, and we check and we obtain the yield, which is the good price. Okay, and now one exercise for you. It's not about the yesterday question, but the today question. When I prepare, I believe that we would get to the bond market quicker. I have a question for you. What is the price of the bond? I give you 3 minutes. I wait price. Okay, just look. It's a zero coupon bond. I help you. DBR Deutsche Bundesrepublik, zero coupon. Maturity 30 years. Yield 0.044. It's a positive yield. On the 30-year German bond, the yield is positive. What is roughly the price? Okay, you send me a message. What is roughly the price of this bond? I wait for answers. First, higher or lower than 100? And then roughly how much? Without any computer, just looking at the screen, what is roughly the price of the bond? Okay, Tong Win says higher than 100. Is everybody okay? Lower. Whoa. And now, you know, I don't know if, or probably yes, you know, the economist, the British economist, Keynes, he wrote something about what we call the beauty contest. That is, if you want to win, either you think by yourself, and you think by yourself the answer, or you look at the answers given by other people. And TUI gave us an answer which is lower. Before her, and someone, Tong Win, gave us a price higher than 100. Now it's lower or higher. Either you say, I think that TUI is worse than Tong Win. So I will take the answer given by Tong Win. Or you say, oh no, TUI answers very well. I give her answer. I don't understand anything, but I am sure she's right. So now you think that TUI is okay because numerous Many of you say lower than 100, but one of you said higher. Okay, who is right? I wait for some other answers, please, before giving you the answer. Is TUI okay or not okay? It should be lower, my mistake. Aha. Aha. Okay, sure. Thank you for the last answer. It should be lower. Yes, sure. It would be lower. Why? The yield is 0.044. First step, if a 30-year bond paid a coupon of 0.044, same as yield, its price would be 100. So if you have a 30 years bond with a coupon equal to the yield, its price is 100. You have to be very, very familiar with that. So if the German bond pays a coupon of 0.044, its price is 100. This bond pays a coupon of 0. Price is lower than 100. If you buy it, you will not receive a coupon of 0.044, but of 0. What is the price? Give me the price roughly. All of you gave me a good answer, lower than 100. Roughly how much, please? Tell me. T2 Nguyen, first answer around 98.73. Okay. I wait for other answers. And here is the same as beauty contest. Either you think the answer is good and you tell the same answer, or you say, oh no, this guy or this lady, I don't know, generally gives bad answers. I make the opposite. Do you trust T2 Nguyen? Okay, I wait for answer. Normally, the interest of the exercise is to be quick. If you want to compute that with your computer, okay, you take 1 minute. But here the idea is I look this bond and I immediately roughly, okay, I like roughly. You cannot say exactly, it's roughly around 100 minus 30 times 0.044. That's marvelous. That's a perfect answer. 98.68. Okay, so yes, it's 29 years, not 30, but okay, it's roughly the same thing. Okay, because on your screen on Bloomberg they say 30. Okay, the idea just to have an idea of the bond, not exactly. Okay, answers which have been given are very good. Congratulations. Okay, we look now. Whoa, 98.74. Great. Okay, so if now you want exactly to compute, you say the price you is 100 divided by 1 plus yield. Yield is 0.044 power number of years. And as one of you said, it's not exactly 30 years, but 29 years, right? So, and you compute on your computer and you find the good price. But my idea here is if you are working in the finance world, okay, you have your computer, which will give you the exact result, but you have to understand and to see if you have a bond with a zero coupon bond, yield 0.044, immediately the price is lower than 100. How much? Roughly 30 or 29 times 0.44. Okay? And so roughly 98.70. That's good. It's enough. If you want the good answer, you look at your screen on Bloomberg or you use your computer. Okay, I'm very happy because you find that very quick. Good, fine. Now, to be ready, a last exercise. What's the price? Quick, you answer. You give me the answer quickly. Lower than 100, higher than 100. And then which price? Yes, immediately I look at more than 100. On the right, you have the yield. Should be higher given the yield is negative. Yes, absolutely right. Absolutely right. How much roughly? Roughly 104 for 3. I'm okay. I would say slightly higher than 104. Why? Because again, for people who are not so familiar, who have maybe more difficulties, if the coupon was equal to the yield, negative coupon minus 0.427, the price of the bond would be 100. This bond is a zero coupon bond, so the price is higher than 100. How much? 0.4027 for 27 each year during 10 years, roughly 4.27. But normally you have the discount and the yield is negative, so it's slightly higher than 104.27 normally. Look. Wow. 1.4.35. Very good. Very good. When one of you said 104, the answer is outstanding, perfect. Not you cannot be better than your computer, and it's stupid, very stupid, to imagine that the objective of my exercise is that you go quicker than the computer. Objective of my exercise is that when you look in the A's, you look at a bond, you roughly know its price. And when one of you said it's 104, it's perfect. 104. It's higher than 100, roughly 10 times 04. 27 discounted, but it has no sense to go in this kind of details. A bond, I look at what is, I wrote, a bond with a coupon equal to minus 0.427 with a price of 100. As it's a zero coupon bond, its price is 100 plus the sum of 0.2427 each year during 10 years discounted. The price is slightly higher than 104.27, exactly what we observe. Good, you can be now a trader, a bond trader. Okay, to be a very good trader, you have another thing. I hope, and I am sure you learned that before. It's what we call the sensitivity of a bond. It is that the price of the bond moves. If the yield moves up, the price moves down. Okay. In fact, if the price moves down, the yield moves up. Okay, because don't forget we price with a price. We don't price with the yield. Many people say if the interest rate moves up, the price moves down. In the reality of the market, that is, if the price moves down, the yield moves up. Okay, because we don't trade in yields, we trade in price. So if people buy bonds because they think it's good, because the level of interest rate will move down, they buy bonds. And as they buy bonds, the price of the bond moves up. And if the price of the bond moves up, as you did now, you know that the yield will move down. Okay. I have some question before we go to further things. Do we trade bonds with no coupon? Okay, maybe you quickly answer, because I think these questions are very, very easy. I don't know why I put these questions. They are so easy. Okay, I wait for some answers. Yes, do we trade bond with no coupon? Yes, it's what we call zero coupon. You put 1, 2, 3, 4. You give me the answers, and after we give you the solution. But honestly, that's too easy for you. First question: Do we trade bonds with no coupon? Yes, we trade zero coupon bond. How do we price a zero coupon bond 10 years? What is the formula? Maybe you send me the formula. What is difficult is I cannot quickly par 100. No. No. I don't understand what you say. Ah, okay. Yes, TWI gives us a good but more complex than expected answer. Okay, no, I just wanted to tell you that the price of the zero coupon bond is just 100 divided by 1 plus yield power 10. Okay, but which is quick, roughly 100 plus 10 years times yield. Yes, you are right. Okay. I was surprised, but okay, you are right. Okay, but what I was expecting, but the answer given by TWI is absolutely okay. It was just 100 divided by 1 plus yield power 10. Okay. Um, no, you are not okay. No. Question 3: Do we trade bond with negative coupon? No. Great. We maybe in the future we trade bonds with negative coupons. It's a innovation, but today really we don't trade bond with negative coupon. And 4 question: Do we trade bond with a negative yield? Okay, don't answer, it's too easy. It's surely yes. Okay, yes, because if my deposit account has an interest rate which is negative, I accept to buy bonds with negative yield. Okay, fine. I just would like to tell you something, and to speak 1 minute about uh, Italy. You know who is Prime Minister of Italy? It's Mario Draghi, which was before president of the European Central Bank, and who before was working for Goldman Sachs, a small bank in United States. Um, Italy is a large issuer. The French Italian Treasury is a large issuer of zero coupon bond. The Treasury. Why? Because maybe you know that's a public economy, that in the budget, in the budget of your country, you have receipts, something you receive, fiscal receipts essentially, and you have expenses in the budget. Sure. Among the expenses, you have the interest rate you pay on your debt. When a country is in debt, and every country is in debt, okay, it pays interest rates and it pays coupon, and coupon are in the budget. It's a large expense of the budget. A long time in France, I don't know the situation in Vietnam, interest rates on our debt was the first, the larger element of expense. That before education, before I don't know what, before health, you have financial coupons, bond coupons. Okay, and Italy says, oh, one thing very interesting would be to issue zero coupon bond. When you issue zero coupon bond, you don't pay any coupon. You just pay the capital. You receive today, if the interest rate is positive, the yield is positive, like in Italy today, you issue a bond, you receive, for instance, 97, you will pay zero coupon, and at the end, you will reimburse 100. You have an implied positive yield, okay, because you just receive 97 and you have to reimburse 100. But the coupon is, oh, sorry, I must, okay, I just have a call. Quickly, I just come back in 1 minute. Okay, sorry, excuse me, I had a call and I was obliged to answer. Um, yes, and what I was telling you is that if you issue zero coupon in the budget of your country, you don't have any financial expense because only the coupons are in the budget, not debt reimbursement. So be careful with that. What we call moral hazard in economics. The mystery of negative interest rates. I think that you know that. You will look at the slides after, but I explained already why interest rates are negative. You know, since 2019, the deposit facility for banks is negative at minus, as you can look, minus 0.5%. Okay. Banks prefer buying risk-free bonds with a negative yield but higher than minus 0.50 for banks than keeping their monetary base on the deposit account with a negative interest rate. Oh, question 4 before going to derivatives. You answer quickly, 1, 2, 3. Okay, you hold a 10 years bond coupon 2%, yield 1%. What is approximately its price? You tell me immediately. Okay. What is approximately its price? I have a good news for you. In 40 minutes, maybe before it's the end. You can use your Saturday and going for dancing or I don't know what. Or looking the TV for having a dinner with friends. So you have to be quick. If you want to end quick, maybe you answer quick to the question. Okay? Nobody want to answer? You have a 10-year bonds coupon 2%, yield 1%. What is approximately its price? Oh yeah, I have a seventh question. Do you hear me? Can you just tell me if you hear me? Because nobody answers. Yes, you heard me. Okay, sorry. Okay, so normally in 2 minutes, if you want to be a bond trader working in an insurance company on bond management, portfolio management, what is approximately the price? The end is in 40 minutes. Please ask, answer. Nobody wants to answer. Okay, if you don't want to answer, I will answer myself. And you will tell me if I am wrong. Okay, maybe you say you are wrong or you are okay. What is approximately its price? I would say 90. 90. I am wrong or I am okay? Is my answer good or bad? 90, the price, roughly. Everybody has left the session or what? No. Yes. Yes, yes, yes. Two is okay. No, the answer is bad because the yield. No, it's not because the yield is positive. It's because the yield is lower than the coupon. Understand? If the coupon was 1%, equivalent to the yield, the bond would have a price of 100. As uh, the, the bond pays a coupon 1% higher than the yield, the bond price is 100 plus 1%, difference between 2% and 1%, over 10 years, discounted at 1%. So it's roughly lower than 110 because it's 100 plus, because again, if my bond pays a coupon equal to the yield, its price is 100. You have to be comfortable with this idea. Here you have a bond with a coupon which is 2%. Everybody wants to buy from you. So what happens? The price is higher than 100. How much? If I buy a bond, I have a return which is 1% each year higher than a bond which pays a coupon of 1%. So the price is 100 plus 1%, difference between 2% and 1%, over 10 years discounted. So roughly 110, I would say. 109, sorry, 109. Maybe you use Excel and you compute by yourself the price of this bond, and I am sure you will find something close to 110, 9, sorry, 109. Okay. Investors like this bond and massively buy it. Its price moves up to 120. Oh, very difficult question. Does its yield move up or down? Please answer. Price goes up, yield goes down. Sure. Okay. Everybody knows that. If the price moves up, the guy who buys at 120 surely has a yield which is lower. Okay, fine. Great. What is the new yield roughly? Have you an idea of the yield roughly? What would be the new yield if the price is 120? Okay, I will give you the answer because you seem to be silent. Roughly 4%. Why? Because if the yield was 2%, 2%, the price of your 2 years coupon bond would be 100. You hold a bond with a 2% coupon. If the yield was 2%, the price of your bond would be 100. And your bond is traded at 110 over 10 years. So in fact, the yield is slightly 2% higher than your coupon, that is 4%. Okay, why? Because 2% each year during 10 years is around 20. So my bet here is that the new yield is roughly equal to 4% because a coupon bond paying a coupon of 2% over 10 years, if the yield is 2%, its price is 100. As its price is 120, it's because the yield is roughly 2% each year higher, which is, no, sorry, it's not 4, it's 0 because the yield move down. It's the opposite, it's 0. Okay, so the new yield would be 0. So if you have a bond with a coupon of 2%, its price would be 100. Okay, if the yield is 0%, your bond has a price which is close to 100 plus 2% per year during 10 years is around 110. Same question if you hold a 5 years bond coupon. Okay, I let this question for you. You do that by yourself when you want, because I know that you don't answer now, so you are maybe a little tired, and I can understand that. So you keep this question for you, and we'll see after. Okay, I don't speak now about sensitivity and duration because I think you are a little tired, and I will begin. We will come back after. I will begin. Okay. Okay. I will. It's slides from last year here because I did not change the the date, but the idea is the same. Okay. I have a question for you, and I would like that you answer. Okay. So imagine now we go to derivatives and hedging with derivatives. As I told you in the first session, you have three kinds of derivatives market. You have forward and futures, you have options, and you have swaps. And today we will speak about hedging with forward or futures. And the first step in the last minutes before the end of the session, but just we begin, is to understand the relation between the forward price and the spot price. Let me ask you a question, and I hope you answer because it's better. As I cannot write on the slide, it's very difficult for me because I use figures and okay. So I hope you answer. Imagine you are a cake producer. You produce cakes, and for producing cakes, you need butter, you need sugar, you need wheat for flour, and maybe you need cocoa. Okay, so you need 4 commodities, soft commodities. If you produce cakes, you make your budget for the year 2022 next year, okay, and you say maybe the price of these commodities will move up. I would like to hedge against higher prices. and you decide to use a futures market to hedge your exposure. My question is following: the wheat price now, assume, is $300 per year. $300 per year. Maybe you put on your sheet of paper the price, because as I cannot write on the blackboard, it's impossible for me to you have to keep the price. So the wheat price is traded spot at $300 per ton, and you ask someone to buy from him wheat in 3 months at a forward price, which is a price which is known today for delivery in 3 months. That's exactly what we call a forward transaction. My question is, what is the price which will be quoted by the wheat seller, the forward wheat seller? Please tell me. You want to hedge your exposure because you are you will buy wheat in 3 months for producing your cakes. The spot is today at $300 per ton, and you want to be hedged. You ask for a trader and you say, okay, I would like to buy from you wheat in 3 months. Give me a price. How does a trader in the company price in Cargill or Glencore? How big trading companies trading wheat, how do they determine the price? Oh, you forget? You never learned? Okay, let me give you the answer. Maybe a few. I believed everybody was sleeping. Really? I thought that. Oh, fine. A lot of answers. Okay, higher than $300 because it's including storing cost. Perfect. Futures price is spot price plus interest rates plus storage cost. Perfect. The price will be today price plus cost plus insurance. Perfect. Yes, all the answers are very good, but that's very important to know at the beginning the relation between forward price and spot price. If you ask a trading company for buying, for instance, 10,000 tons wheat in 3 months at a predetermined price, which is a forward price, the company will hedge its exposure. The company who will sell you in 3 months will today borrow over 3 months horizon at the money market rate the amount needed for buying spot. Buying spot 500,000 bushels wheat or 10,000 tons wheat, store and insure the physical exposure. So the forward price will be equal to spot price plus cost of financing, 1 plus interest rates times T, plus storage cost plus insurance cost. So you were right, people. Some of you who wrote this equation, maybe you forgot cost of financing, because if you want to hedge, I am a trading company. I have to deliver 3 months wheat to my customer. Immediately, I borrow money on the money market at the interest rate. I have a cost of financing if the interest rate is positive. I buy spot the 10,000 tons of wheat. I store them during 3 months. I have storage cost. I have insurance cost. So the forward price for wheat will be spot plus cost of financing plus cost of storage plus cost of insurance. So normally the commodity curve is increasing with time. The higher is the expiration date, the higher is the forward price, because interest rate, storage costs are higher with time. So my here, before leaving and giving you Saturday for leisure, don't forget, but I think that you know already very well, the forward price is normally theoretically equal to spot price plus storage cost plus insurance cost. Imagine now that this relation is not, I don't know if it's on my next slide, illustration, spot price, okay, it's bachelor, okay, no, it's okay, I will see that after. Okay, imagine now that the market price, the foreign market price, is higher than spot plus interest rate plus storage cost plus insurance cost. Imagine that the market price, the price traded on the market, is higher than this theoretical formula. What would happen? What would happen? And I give you an example. If imagine the spot price for wheat is traded at $300 per ton. I told you that, $300. The cost of storing is $1 per month. $1 per month. Interest rate is 0 to be comfortable with that, and insurance cost is with storage cost equal to $1 per year. Okay, so storage and insurance is $1 per month. Interest rate is 0. Spot is 3. Normally, the 3 months forward price would be 300 plus 3. One storage cost per month, $1. It's 303. 303. Okay. Imagine now on the market, futures market, the price is traded at 340. 340 instead of 303. What would happen immediately? What would happen immediately? If the market price, the futures market price, 3 months would be traded at 340, and that the theoretical formula, spot plus cost of financing plus cost of storage, would be 303. What would happen immediately? Really, I think that Saturday morning is a bad day for learning because we are tired, maybe for teaching also. Yes, yes. Buy commodity spot and sell futures. Yes, for every people here. The idea is, if the futures price would 340, higher than spot plus cost of storage plus cost of financing, every trader in a trading company would borrow money at, for instance, 0%, buy spot commodity $300 per ton, and store the commodity they bought during 3 months. So cost of buying and storing and financing the wheat would be 303. And immediately, as your colleague said, you sell a future, you sell forward at 340, and you sleep during 3 months. In 3 months, you awake, okay? And you have wheat with the cost of buying, which was 303. You sell it at 340 because you sold the future. You sold forward your wheat. You bought on the spot and you stored. So you have a gain of $37 per ton. It's 340 minus 303. So you have a risk-free gain of $37 per ton. This risk-free gain is what we call an arbitrage, because an arbitrage is a profit without any risk. Buying spot, selling future has a name. It's a well-known arbitrage on the financial market. What is the name of I buy spot, I sell futures if the futures price is higher than spot plus cost of carry. What is the name of this arbitrage? What is the name? Cash and carry. Yes, fine. Did you have already a lesson on commodity futures, or because you seem to know that very well? It's just one of you who knows very well, or did you receive a course on commodity futures? It's strange for you, so it's not known, okay? And Tui, could you explain us why you know so well? It's because you work in this area, or it's because in a old life you made studies about that? You learn from CFA. Okay. So sorry for Tui because he knows very well already, but for other people, the beginning of hedging is in fact knowing the relation between forward and spot. So now, and we will end the session with another example, and after we stop. So my advice, my hope is that you answer. It's the last exercise after we stop. So I know that you are tired. I am also tired. Everybody is tired. So we will stop just after my exercise. I have a question for you. And I am so sorry not to be able to write on the blackboard. So put on the screen the data I will give you. Imagine a stock price, the Amazon price, equity price, Amazon equity price is traded on the spot market at $1,000. The spot equity price, the spot, it's if you buy immediately and you pay immediately, you receive immediately. The Amazon equity price is traded on the spot market at $1,000. Interest rate is 3 months interest rate is 0. It's an assumption. I am an investor. I am a fund. I know that in 3 months I will receive a lot of money from an investor. And this guy told me, with the money I will give you, you will buy from me Amazon equities in 3 months. I will give you money and you will buy equity, Amazon equity. And he tells me, yes, but I have a equity risk. If the price of Amazon moves up during the 3 following months, I will pay more, or I will receive a lower quantity of Amazon equities for the amount of money I will bring. So you have an equity risk. You want to be hedged, and you ask a trader in a bank at Société Générale, no, Vietcombank, and you tell the equity trader of Vietcombank, okay, give me a price, forward price. If I buy from you Amazon equities in 3 months, give me a price today. If I buy from you Amazon equities in 3 months, please give me the price of the forward price of Amazon in 3 months. The spot is $1,000. Interest rate is 0. You can ask me for other data, but you are able to give me the forward price. And after we stop, so I hope you answer quickly. To know how we build forward price, imagine you are the trader in the bank. That's it's still okay. I have a first answer. It's 1,000. Okay, I will answer after. If you want to compute, you imagine you are the trader. I am the investor. I tell you, I would like to, you are working in a bank. I would like to have a price today for Amazon if I buy Amazon equity in 3 months. Immediately, you are the banker. You will hedge your exposure by buying immediately Amazon on the spot market. So you borrow, you buy spot Amazon, and you keep Amazon in your portfolio during 3 months. After you can deliver Amazon at a given price. So one of you said the price is 1,000. Why? Because if the interest rate is 0, I tell you, I would like to buy Amazon equities in 3 months at a price you will give me today. You will hedge. You will not take the risk. You will hedge by buying immediately on the spot market the equities. But for buying equities, you have to borrow money. So you borrow at 0%. You buy the equities and you save them. You store them. So you are sure that in 3 months, you can deliver your equities at a price which has been determined today. What is this price? What price plus cost of financing? But as it's 0, it's 0. The void price is 1,000, as your colleague said. But be careful. It's a very, very, very good answer. Not a perfect answer. Why? Because you don't have any cost of storage if you keep equities. If you keep wheat, you have storage cost. If you keep, I don't know, another commodity, you have storage cost. Oil, for instance. But equity, no. But what can happen if you store equity? You borrow, you buy spot, and you keep 3 months Amazon equity. What can happen? It's not a cost of carry, but it's something you have to listen. What can happen? It's not a problem, risk of price fluctuation, because you will deliver equities to your customer at a predetermined price. Okay, so it's a problem of your customer if the price moves down, because you bought today at the price today. You borrowed money, you bought the equity, you keep them 3 months. If the price fluctuates, it's not your problem. You will deliver your equities at the price which has been defined at the beginning, spot plus financing. No, the risk. No, I mean, we may sell at higher price than the forward price. No. Be careful. No. Okay. You are the bank. You are not the investor. The investor asks you, I would like a price for buying from you equity, Amazon equities in 3 months. Your hedge will be, I borrow money, I buy today spot Amazon, I keep Amazon. So I would be able to deliver Amazon at a forward price. That is a price which has been determined today. Which price? As you said, spot price plus cost of financing. This forward price will not change. It's the problem of the customer. If the price has moved down, okay, he will buy from me at 1,000, maybe sell it at 500, but it's its problem. It's not the bank problem. So, no, think you are the banker. You borrowed money, you bought spot the equities, you keep them till 3 months. In the financial world, what can happen if you keep equities? Good news, not bad news. Good news if you keep equities. What can happen? Oh, it's something you know very well. I am sure. I am 100% sure. Oh, I love the last answer. Dividend. If you are the banker, you are Vietcom Bank. You work on the equity derivatives department. I am an investor. I ask you, I would like a price. If I buy from you Amazon equities in 3 months, and you tell me no problem, I will give you the price. I borrow money, I buy spot, I keep the equities. And I tell you, my forward price is spot plus cost of financing, 0. But I will receive dividend if I do that. So the forward price is spot price plus cost of financing, it's interest rate, minus or plus dividend, minus or plus dividend, minus or plus for the forward price. Good. Minus, because the bank will receive the dividends because it keeps Amazon equities. So the theoretical formula for equities for the forward price is spot price plus cost of financing minus dividends if you have some dividends. So that means that if you don't have any dividends, the forward price curve is increasing because the interest rate, the cost of financing is higher with the maturity. But if you have dividend during the period, the forward price can be lower than the spot price. Okay, so very important to be familiar with that. The forward price of an equity is equal to the spot price of the equity plus interest rate minus dividend. And exactly as I told you for the wheat, imagine that Amazon is traded at 1,000. Imagine there is no dividend. Imagine the interest rate is 0. So the forward price is, as one of you told me at the beginning, it's 1,000. Imagine now the market price, the forward price traded in the market is not 1,000, but 1,200. What do all the arbitrageurs in the trading rooms of all the banks when they see forward price 1,200 and spot plus cost of financing only 1,000? They make a cash and carry. They borrow money at 0%. They buy immediately Amazon at 1,000, and they immediately sell Amazon on the foreign market at 1,200 if it's the market price. And they have a risk-free gain in 3 months of $200. Everybody would do that. It's so easy to make money with that. It's cash and carry again. But as it's so easy, all the traders in the world would buy Amazon on the spot market, would borrow, buy Amazon, and sell forward Amazon. So the spot price would move up, the forward price would move down till what? Till that the forward is equal to spot plus cost of financing minus dividend, but there is no dividend in my example. Okay, so what is very important is that if the forward price is at any moment different from spot plus cost of financing, immediately you have a cash and carry arbitrage. And maybe you can make money during 1 second, 2 seconds, if you are the first one to do that, but after it's too late. It's the reason why if you look at your screen, okay, you will see that the forward price is at any moment equal to spot plus cost of carry. Because if at one moment you have a difference between the market forward price and spot plus carry, immediately 25 years old traders, well educated, make an arbitrage because they are paid. I don't know if it's good or not bad to make money. And if you can make money risk-free, that's better. And cash and carry arbitrage is a more familiar arbitrage between spot and futures of forward. Okay? So I think that you are happy now because it's really the end. sorry for not being able to write on the blackboard. I hope till tomorrow, but I have not technical help during the weekend, but I will try to do that to be able to write on my blackboard. It's okay. Do you have any question before we leave and before you are free? I understand that it's so difficult for you. Okay. As yesterday, if you could, before going to your dinner or meeting friends, sent me some message about the today's session. If you learned something, if you didn't learn anything, you can do what you want, because tomorrow we have another lesson. Is better if I know what you appreciated and did not appreciate during the session. Okay, to adapt. Okay, so tell me it was too quick on bounds or too slow on bounds. I didn't learn anything, or I learned a lot, or what you want. Okay, before leaving, please tell me some message like that, and I hope you a very nice evening. Okay, see you tomorrow.
You are currently the only person in this conference. You are currently the only person in this conference. You are currently the only person in this conference. You are currently the only person in this conference.
Et voilà, et c'est là où ça marche pas. Là, ils voient pas les étudiants quand je fais ça. Non, mais parce que faut faire ça.
Oui, mais après.
Voilà. Et eux, ils voient pas.
Pardon.
Non, c'est pas grave.
Euh,
Attends, on va gommer parce que je vais gommer en même temps là-haut. Le truc là. C'est où là. Voilà. Ok.
Vous
Et
avez
après, je fais
écran
quoi?
partagé, c'est ça?
Voilà, il me dit qu'il faut le faire sur le PowerPoint.
Bah oui, mais c'est pas un PowerPoint. En fait, c'est pas un PowerPoint, ça.
Mais si, je l'ai pris sur PowerPoint. Ça, c'est PowerPoint.
Oui, mais en fait, c'est pas ton PowerPoint.
Mais c'est quoi?
Ah, en fait, je suis
Regarde,
suis
stop.
vraiment pas sûre de comprendre ce que je veux
Bon,
dire
d'accord.
maintenant.
Ok. Bon, attends, je vais voir avec Colin alors, c'est pas grave.
Parce que celui-ci, tu peux pas le partager, quoi. Si je fais... Attends, je peux? Comment t'arrives à savoir?
Non, là, il faut mettre ça.
Et tu peux mettre le pointeur aussi. T'es pas obligé...
Mais
parce
là,
que
ça
je vais
marche.
pas écrire ça. Je vais regarder ça.
Mais ils voient pas. Bon, je vais attends, parce qu'il faut que je fasse autre chose. Là, j'ai un travail à faire pour demain, donc je vais le faire en attendant. Voilà. Et là,
Sinon,
ça va pas
c'est
dedans.
ça qu'il faut que je regarde. Direction, peut-être.
Non.
Attends, Colin, vas-y.
Merci, laisse. Tiens, le thé est prêt, tu peux le mettre? Et puis vous servir, moi je me suis déjà servi là. Il est prêt, hein, le thé. Hein.
Comment?
Appelez maman. Hein.
Oui, j'attends.
Ça va, Lulu? C'est ça qui joue? Ah merde! Donc il va passer dernier? Ouais, il est prêt là-bas, le thé.
Il est là-bas?
Ouais.
Dans la cuisine?
Je pense, ouais.
You are currently the only person in this conference.
Non, mais tu sais, comme ça check qui vont être un peu genre petillons. Ouais. Oui, j'aime bien ce que je fais. Oui, c'est joli, hein. Et c'est facile à jouer. C'est quoi? C'est dans quel livre? Ah, romantique, la musique romantique. Comment? C'est romantique,
Colin, tu pourras me montrer comment je peux utiliser ça?
Song without words. Et niveau 1, 3. Non, je crois pas. Regardez, tiens. Colin, t'as regardé comment papa pouvait partager son écran? C'est pas toi, Colin, qui m'a offert ça. C'est ce que jouait Loulou là. Histoire de m'aurait habitué.
Comment je fais, Colin? Vite fait.
Je sais pas du tout. J'ai pas le temps.
Bon, alors fais pas le temps.
Je vais pas voir.
Oh, d'accord, ok, merci.
Parce qu'en fait, oui, mais le problème, c'est que son PowerPoint, il est directement sur le site dans lequel il se connecte. Non, ça va?
Mais ça, tu me démontres, voilà. C'est ça mon truc. Je comprends pas, moi, hein, c'est tout.
Où, là?
Ouais, je te montre quand même. Hein, où je suis.
C'est
Sinon, non, ça c'est PowerPoint.
Ben, c'est pas
Ça n'a rien à voir. Et non, parce que mais non, je rentre mon fichier, je l'enregistre sous Canvas quand je rentre dans le truc.
Ouais, c'est pour ça que je crois que ça va être un peu compliqué en fait.
Ok, personne ne veut m'aider, ok.
Non. Bon.
Merci pour moi.
Oh, comme ça, le fait de mettre de la poudre de noisette, ça donne vraiment ce goût noisette. Oui, hein. Bon, hein. J'adore. Les poudres de noisette, c'est quoi? Nationale, huile de noisette. Ouais, voilà, c'est ça, huile de noisette de l'huile. Huile de pépins de raisin, fécule de maïs.
J'ai pas de maillot de bain ici. Hein.
Ah si, tu dois avoir un maillot de bain. Ah, il y a une piscine là-bas? Vous allez sauter dans la piscine? J'aime bien le piano. Quand alors, ouais, c'est sympa. Hein. Je vais, je pense, prendre un billet pour Pompéi, une visite avec un archéologue.
Je suis super en retard. Les dépêches.
Tiens, tu m'en donnes une
T'as les clés, t'as tout?
Ouais, par là-bas.
Tu dors là-bas?
Ouais, je pense. Ouais. Bah, c'est bon.
Ah bah on va pas se voir, ça se trouve.
Si, si, j'entends.
Ah oui, mais moi, peut-être que je serai pas là. Hein. Bon, ok. Ok, d'accord, ça va aller. Du coup. Sympa, ouais, une visite avec un mec. En groupe?
Ah, en français ou en groupe?
Ah, c'est cool.
Je vais plus prendre ça, mais j'hésitais à prendre le lendemain, notre arrivée à 9h30. Ça veut dire qu'il faut prendre un train à 8h30.
Non, non, s'il te plaît, tu te calmes,
Ouais,
parce
là-bas.
que... Non, 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 mais moi je viens pas. Hein. Je veux dire, si c'est pour faire des trucs, on arrive à minuit, on part à 5 heures, peut-être tu rigoles, mais moi, soit c'est
pour
des
ça que
vacances,
j'hésitais.
soit c'est des vacances, soit c'est du ridicule, quoi.
Mais enfin, ça me fait rire parce que ouais, Mariam me disait parce qu'il y a deux sortes de copines. Il y a des copines où c'est vachement que plage, etc. Et une copine qui était à l'inverse.
Non, moi je suis pas que plage, d'ailleurs, j'ai jamais à la plage. Mais c'est
Non, mais
ridicule
non,
d'arriver
non, mais
crevé
des trucs
et de
tous les
repartir le
jours
matin à
6
8
heures
heures,
du
quoi.
matin,
C'est idiot. C'est même
aller se
pire que
lever.
ça, c'est complètement con.
C'était toute la journée et apparemment c'était vraiment très compliqué. Non, mais d'un autre côté, si quand vous êtes sur le lieu, c'est bien de faire ce qu'on peut, quoi. Si vous avez peu de temps. 9h30, le train, il faut prendre un train à 8h30. C'est pas très. Vous arrivez à quelle heure le lendemain?
10h. On a le temps de
Oui.
visiter, de se reposer.
Oui, oui. Bon, je crois que c'est faisable, ça, non?
On s'en fout.
Ah, c'est mieux, oui, mais. 2018, t'as pas pu, jeune?
On peut faire un truc en groupe où ils nous prennent à l'hôtel en car, mais c'est moins drôle, quoi. On y va en train, et puis c'est... Et on a cette visite guidée, c'est quand même plus sympa d'être avec
Attention,
un
parce que.
archéologue.
Ouais, c'est ça. En vrai, si vous arrivez à 6h, vous faites attention. 8h30, c'est faisable. Si vous êtes près de la gare, vous réveillez à 7h, vous partez à 7h30. Le week-end, qu'est-ce qu'on a? Même personne qui écrit toutes les critiques de
Attends, là je travaille. Hein. Non, la réponse est non.
Tu sais quoi? Il y en a parce que dans le Bring ils disent beaucoup romantique. À chaque fois, il écrit romantique, affaires, cuisine d'auteur dans les mots-clés.
Les mots-clés, quoi.
Dis-nous. Dans les mots-clés des restaurants, de genre ils
Ah oui,
disent pas
un
génial.
restaurant romantique, ça veut dire pour un dîner en amoureux, quoi.
Non, mais
En
c'est
fait,
tous romantiques. Bah oui.
bon, peut-être
En avoir un deuxième ou c'est trop de chips qui sont pour toi?
Oh, vas-y, prends-les. C'est tellement agréable.
Non, j'en veux pas.
Mais j'en peux pas, hein, je vais pas les garder.
Moi non plus. Moi non plus.
Je regardais là, là on a pris le ici cassette, je crois. Expérience. Et là, il y a un canapé lit et un grand lit double. Donc ça, si, il y a des...
Ah, un petit gâteau, le Merci, c'est très bon.
C'est la gare. Il y a plusieurs gares ici. Oui. Ah non, non, c'est que non, je pense. Ah, ils ont l'air plus gros que ces deux-là, que les autres. Et je suppose que c'est le métro. Non, la gare. La Pompéi, c'est l'impression qu'il faut prendre le bus après, tu vois, parce que Pompéi, c'est là, mais il faut aller à Villa des Ministries. Il y a marqué une correspondance et je pense que là, hein, si jamais il y a des... Mais ah, et c'est juste à côté le... Ah ouais. On nous attend juste là. Là, celui en 27, c'est pas ça. Non, celui-là, ça va pas. Naples, Piazza Garibaldi. Ah oui, non, t'as raison, il y a un bus qui doit... Voilà. Voilà, la police. Et le problème, c'est que les gars, les moyens les plus... Notre solution, c'est un truc où tu pars en plus de ton hôtel, et tu t'amènes, tu visites avec le troupeau. Ah ouais, on peut passer une journée d'abord en visite. début. Oui, mais après, je sais pas non plus. Moi, à mon avis, il faut pas non plus. Ou alors le truc, ce serait une journée là, mettre une télé avec une on pourrait aussi prendre un hôtel à côté. Le truc, c'est que si le Vésuve et pour la même journée, ça va être très long, quoi. Ça existe, excursion d'une journée au Mont Vésuve et à Pompéi. Parce que le Mont Vésuve, il y a pas grand. Mais c'est une petite excursion, quoi. Tu grimpes, tu regardes les crevants, quoi. Si vous avez marché tout le truc, et machin. En même temps, tu restes là. C'est ce truc là. Regarde, même temps, en gros, on s'assied, mais vous restez sur le vélo. Si c'est moins de 2 heures, ou alors, oui, en effet, tu fais une 2 heures à Pompéi. Le train, tu rentres, toi, tu en profites. C'est une excursion qui fait trop. Là, fais l'excursion. Si t'emmènes en bus.
You are currently the only person in this conference.
Non, donc je ne sais pas comment je vais faire. Moi, c'est pas grave.
T'as jamais vu une passe utilisation où tu connais le nom de ce truc et tu verras comment machin PowerPoint, ils vont t'expliquer.
D'accord.
C'est ça que je veux dire. Qu'est-ce que je disais? Il y a marqué monter au Vésuve en train et en plus. Sur le Vésuve. Le train jusqu'à. Il n'y a pas grand-chose à faire dans les autres villes. Tu peux faire ça la même journée, ce sera là, grand circuit. Non, il y a Herculanum et le Vésuve. Un jour Pompéi, l'autre jour miniature. À côté du Vésuve. Ouais.
Non, c'est une map, je veux dire. Ouais. C'est pas compris. Non, j'ai compris aussi.
You are currently the only person in this conference.
Ça, j'ai fait compris. J'ai l'impression que ça a été énorme, merci. Ça vaut le coup parce que c'est super bien pour ça. Oui, c'est ça en fait. Parce que là, quand tu dis, tu vois, c'est beaucoup de ruines. Parce que là-bas, t'as vraiment la et tout ça. Je pense que tu peux le faire sans guide, mais il vaut mieux faire avec guide. Puis ensuite faire finalement sans guide. Donc peut-être, je me dis, peut-être on peut faire le visio et Herculanon en même temps en bus, quoi. On peut lier avec l'archéologue. C'est une œuvre aussi. C'est bizarre que Herculanon. C'est-à-dire qu'on a donné par exemple. Mais c'est plus large.
Lucille, comment je peux dire lequel c'est which of, c'est ça? The two bonds.
Lequel quoi?
Lequel baisse le plus? Which of the two bonds? Non, lequel des deux baisse le plus?
Je sais pas ça. Which of the... C'est mieux quoi, je pense.
Lulu, tu vas regarder le Stade français si ça t'ennuie pas. Tu vas regarder le Stade français. Ouais, ouais, ouais. Non, mais dans 5 minutes, ça commence, hein.
You are currently the only person in this conference.
Lucille, je vais venir, chérie, tu m'excuses, hein. Je vais venir regarder le match là.
J'ai l'impression que c'est un peu une arnaque là, les tours séparés sur le mont Vésuve, quoi. Ils t'envoient là-bas, mais tu es tout seul, quoi. Bon. Il y a peut-être un vulcanologue qui te parle 10 minutes au sommet. Avec, lui aussi, c'est que si tu vas tout seul, tout seul, c'est en août là. On dit que si tu n'avais pas pris tes billets avant, tu peux pas accéder. Ah ouais, je comprends. Donc ils se sont tapés tout le chemin et puis ils n'ont pas pu rentrer.
Voilà.